Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. Apparently, it wasn't that great of a week for the Dow, but the NASDAQ was up. Ross takes a look at gold, silver, crude, and the U.S. and Canadian dollars. Eric Hadik from InsideTrackTrading.com joins us from California to look at what a cycle progression trend is and how it could affect gold, silver, interest rates, and even cryptocurrencies. Publisher of the newsletters on VRTrader.com, Mark Leibovit checks in from Arizona to chat about central banks and interest rates, what the real rate of inflation might be, and the BRICS meeting in Russia winding up without an announcement about a new gold-backed digital currency that would take on the U.S. dollar. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at ChartsByRoss. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
What kind of a stock market did we have this week?
This is a market that's just going through a bit of a consolidation, a little bit of a slide if you're looking at things such as the Dow, which is down, I guess, about 2.5% off the high at this point. S&P's holding in, and NASDAQ managed to come back and have a pretty decent week. I'm still watching for, the seasonality aspect of it. Typically as you work your way through October into November, you're going to have seen some kind of a low that produces an oversold reading, gives you a decent entry opportunity. And at this point, still not seeing anything like that. The market has been grinding its way higher and now having this slight pause. If we could have a few good down days in the S&P, not so much in the Dow, that can really get manipulated with one or two stocks. But when you look at the S&P, if we can manage to put in a decent oversold, I get pretty excited in that one. And, historically, you want to be looking for this rally in November, December. Typically the best part of it is into the middle of December. You might get a pause there, and then you get a secondary run that takes you into January, and you get that classic Christmas rally, the Santa Claus rally. So, we always want to keep that one in mind. If you get the right buying opportunity, you really load up the back of the truck here in the next couple of weeks, and then look for a retest of the high. If not, they push through to new highs.
What's going on in gold?
Gold, we got up into some pretty hefty territory the early part of the week. On Tuesday, we got the first good overbought reading that we've seen coming out of the lows here. We ended up with the point where up and now the 2750, 2760 range, there's really no overhead resistance. It's just a matter of can it lose a bit of momentum. And I'm looking at the 20-day moving average is probably a decent spot somewhere in the 2550 to 2600 range to provide some support in here. Silver was really strong there for a few days, but has pulled back. Looks as though it's probably going to test its breakout level. The trends still remain up, but a pause was definitely warranted.
What's happening on the crude market?
Crude 71.60 at the end of the week, and you're into the negative seasonal here, so that should take us into December. There's really no sign of life on the upside, so I think you still want to treat it as a market that's in a downtrend, And if we can go down into the 60s, ideally ideally below 65, things can get pretty exciting for the next calendar quarter.
What's happening with the U.S. and Canadian dollars?
U.S. dollar has shown exceptional strength here since the first of last month. It just continues along a 104 and change on the dollar index, and we've ended up with two good overbought readings that have produced virtually nothing in the way of pullbacks. And on the other side of the coin, you're seeing the Canadian, which 10 days ago had capitulation readings, a small 2 or 3 day bounce, and then at the end of the week back down again to new lows. We're sitting down at just under 72 on the Canadian dollar, and the more oversold it gets down in here, the better the potential bounce. I think you probably look at 73 as maybe the maximum on the upside on a bounce at this point. The other currency of note is the euro. While the dollar index has been strong on the upside, the euro has been coming off, and we're getting some capitulation readings in there as of Friday. So I think you could be setting up for a decent bounce as far as the euro is concerned.
The Canadian dollar, its reaction after the Bank of Canada cut rates once again?
It paused for a day or so and then back down. In theory, you'd be thinking that it would be a sell the news item in terms of that the dollar would get hammered. It didn't, but it is easing lower. The other thing is that other than crude oil, which has been holding its own, other commodities, the grains, which have an impact for us as far as the resource side of the equation, as far as the currency is concerned, they are looking heavy again. So at this point, there's really no strong reason to be anything other than short-term bullish on the Canadian for a bit of a bounce.
Ross, thank you so much for the update.
You're welcome, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Eric Hadik. Next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Thanks for having me back, Jim. Pleasure to be here.
Eric, before we get into the questions, can you tell us a bit about Inside Track Trading? And I always ask, why the two I's in inside?
Well, the extra I in inside is because it is an acronym of the markets that were originally the primary focus, and they still are. We've expanded to other markets and market sectors, but it was an acronym of the inflation markets, which is all of your commodities, stock indexes, the SI, then the extra I was interest rates, D was the dollar and related currencies, E was the energy markets. So that was the reason for that. But we offer a advisory and educational tutorial service in technical and cyclical analysis. And it's always been my premise and goal that it's not enough to just provide some analysis, kind of like the old adage, give a man a fish, you feed him for a day, teach him how to fish, he fishes for life. And I'm always very intent on providing the why and the how of where I've reached some of the analysis that I publish. So there's a very strong emphasis on tutorial type of advice as well showing the different indicators, how to use them, how to filter one with another. Also, really identifying what indicators work when, and showing their weak points as well, when you shouldn't really rely on them as much. And so that's really a quick summation of the services that we provide, and we have a monthly newsletter, some intra-month updates, and also a weekly advisory service with intra-week alerts.
Can you explain your cycle progression tool and what it's been revealing to you about stocks?
Yeah, the cycle progression is one of the techniques, indicators that I developed about 30 years ago, really. But my focus when I am discussing cycles and timing indicators, often that term cycles becomes a little generic or a little universal to describe several more specific timing approaches to the market. But my primary focus with cycles is really focusing on when they are at their extremes, when you see highs and lows, when you see more of your acceleration points or your crescendos in markets and in trends, and that can be anything from the actual markets to society to natural and geophysical events. And so you'll often get a higher concentration of indicators, of cycles and timing indicators coming into play at those extremes. It's often the transition point in a broader cycle. And so a perfect description or illustration of that is in stock indexes. Right now in mid-October time frame, mid to late October, there's a convergence of so many cycles from multi-decade ones down to multi-day cycles that have all been forecasting a significant peak at this time. But going back to that cycle progression discussion, you have something like the 17-year cycle that I have discussed all year long. And once again, this time frame beginning in late 2023 and through 2024 and now for the next few years is when that particular longer term cycle is expected to have its biggest impact and time the extremes of many different economic markets and indicators, and seeing a shift to opposing trends. And so coming into this year, coming into 2024, I discussed the 17-year cycle of stock market peaks, and that's something I had written extensively about back in 2006 and 2007. At the time, the conclusion that was published dozens of times was that the stock market should wait until late 2007 to peak and then go into a 1 to 3 year bear market where it would lose 35 to 50% of its value. And that was based on a compilation or summation of the previous phases of that 17-year cycle that timed similar peaks and sharp sell-offs in 1990, in 1973, 74, in 1956, in 1939. And so the cycle progression is something that times the intervals between those peak events. And that, as I said before, is when I really have my sharpest focus on these particular cycles and what I think they are showing for the market. So in the case of stocks, came into this year and just repeatedly explained why I thought we would see two significant peaks in the market, in the stock market, one being in July and the second being in mid-October. And that's very similar to what you saw in past phases of that 17-year cycle. And there were many other factors that corroborated that. I always rely on synergy with this, but it was that cycle progression tool on different magnitudes that was showing the same thing. And so what did you have? You had all the markets rally into mid-July, And the NASDAQ 100, as of right now at least, set its highest peak on July 10th, 11th, I believe it was. And that has not returned to those highs since. And that is exactly what I was explaining, where you'd see divergence between those two time frames if it was going to be the type of peak that I expected. And so then coming into mid to late October, I thought you'd see other indexes do set higher highs, while ones like the NASDAQ 100 and even the Russell 2000 is shaping up like this, they would diverge and set secondary highs. And that was corroborated by a lot of intermediate, multi-month, multi-week, and even multi-day cycles. And I'd say that the Dow Industrials was probably the most noteworthy to me as it was coming into this time frame. And one other thing I should explain about the cycle progression tool is that I illustrate it with a sine wave and some smaller sine waves, and on those sine waves, kind of a fractal approach. But in my work and the way I use this tool, it's not going to time consistent highs ad infinitum, not going to time consistent lows unendingly. It's going to alternate on a particular rhythm. And usually what you'll see 3 to 4 consistent lows on a particular interval, whichever cycle and cycle progression you're discussing. And then after that final low, the next phase of that cycle, the entire time frame will be consumed by an overall rally. So instead of going from a low up to an intervening high and back down to a low, which is a full cycle, once you hit that final low and it's getting ready to kind of exceed an equilibrium point and start to alternate between successive highs, you will see the market move through that entire cycle in an uptrend. And with that as the discussion, then what you typically will see, or at least in the theoretically pure textbook version of this cycle progression, you'll then see 4 successive highs at that interval before, after the final high, then the entire subsequent cycle will be consumed by a downtrend leading into a future low. So with that said, I was describing not only this 17-year cycle in the Dow and why I thought that a final peak would wait until the middle half of October 2024, but there were a lot of corroborating cycles. There was a 1-year 360-degree cycle that had timed the October 2022 low, the October 2023 low, and that was getting to the point where from October 2023 until October 2024 should be a full cycle of an uptrend, a full interval of that 1-year cycle. So that was reinforcing this focus on October. But then that 12-month, 1-year cycle had already been breaking down into 3-month increments, and you had the mid-October 2022 low. Then there were subsequent highs in January, April, and July of 2023. You then had a decline into October 2023. But it was from that point forward that it really started to get into its most precise rhythm. And you saw the Dow after setting its low in October of 2023, then it set a low on January 17th of this year, then a subsequent low another 3 months later on April 17th. And that was the time where that 3-month cycle was now expected to time an entire uptrend into that mid-July, the first of those two 17-year cycle peaks. And sure enough, the Dow did exactly that. So you had this October low to January low to April low, and then into a July high, and that projects a future high 3 months later in the mid-October time frame. So you had you had all this synergy of a lot of cycles coming together and telling me to look at the middle half of October and getting more specific right around October 17th, 18th in the Dow Industrials. Now, each of the indexes kind of diverges a little from the others. There's a little bit of your rotation that goes on. But that was the one I was really focused on, and why I thought October 18th would probably be the peak in the Dow. And right now, over the last few days, it has started to sell off and reinforce that cycle. So it's raising my awareness, my focus, that we could be seeing not just a 1 to 2 week top, but a 1 to 2 month top. And if it can confirm that, it could expand to a much more significant peak in the stock market. And one of the factors that has really convinced me of that is this cycle progression tool and the myriad of different magnitude cycles, all pinpointing that time frame in mid-October for a very significant peak.
Since late last year, your publications have been using a variety of cycle progressions to anticipate a gold and silver rally into this current time frame. Can you elaborate on that and give us an update?
Yeah. And now that I've described the cycle progression tool, I can kind of just jump right into some of the specifics with gold. And really, gold has been one of the most consistent markets over the last, really about 8 to 10 years, where it has had its most precise cycle has been right about a 12.5-month cycle. On a weekly basis, it has diverged or expanded from between 54 weeks and 59 weeks. It has timed successions of consistent highs and at the same time successive lows on two different phases of cycles, but on that same interval. And so it has just continued to reinforce that cycle in the gold market. And so one of the things that I was talking about, I explained back in late 2022 why I thought a major low was going to be set in gold, that would complete its basically 2-year correction from the late 2020 peak. And it kind of was just trading sideways, more of a flat correction if you're using Elliott wave terminology. But late 2022 was the latest phase of a 7-year cycle progression that timed lows in 2001, 2008, 2015, and was coming back into play in late 2022. And along with a lot of other cycles, but gold was also testing some critical price support levels and downside objectives. I mean, it was just a wide variety of indicators, all reinforcing this conclusion that a major low should be taking hold. And from that, it set its subsequent low about a year later in October 2023, and it had already set some previous lows on that same 12.5 month interval. And so the higher probability was that it was getting ready to break out into a 12.5 month advance, which would take it into the second half of October 2024 right now, and then set some successive peaks. There's already several timing indicators telling me to watch October/November of 2025 for the next really significant peak. And so it's reinforcing that this cycle progression is going through its normal evolution. And with that, gold was poised to rally on balance from the October 2023 low into an October 2024 peak. And there have been a lot of corroborating cycles, as is always the case, but that is one of the ones that I have been discussing the most because it has been so consistent. And so you've got gold and silver surging into this time frame, and this is where the technical / price indicators really become the most critical, because I would never recommend trading just off of cycles unless you've got deep pockets and a lot of leeway in when and where you enter markets. For me, they're just a backdrop. They kind of set the stage, and then it's time for more specific indicators, both price and timing, to take control. And so you've got gold and silver filling this upside. One of the things I had to see in silver to really validate it was for it to rally up to $34 or higher, which it has done that. And now just because it fulfills certain upside objectives doesn't mean that a top is in place. That is just, those are objectives to be used when you are trading the market in long positions. You get an idea of certain targets and goals you have, and then once they're fulfilled, you either start lightening up on your long positions, or you start to tighten your trailing stops, and the timing tells you to start narrowing your focus a bit so you're not giving back a large percentage of your gains in a quick, sharp correction. And so we're into that time frame now, and gold and silver have shown a little bit of signs of toppiness, but nothing that has triggered any reversal signals yet. So the trends are still up, and we're in this multi-week time frame when a pretty significant top is expected, but price action hasn't yet determined that a top is in place. And so until it does, there's always more upside potential.
Interest rates have been climbing again. Do you expect that to continue? And what impact is that having on other markets?
Well, the bond market, which trades inversely to interest rates, as I'm sure most of your listeners are aware of, but just so that it's not confusing when I'm describing my analysis in the bond market, everything was showing me that bonds should rally from last October into August of this year, and then begin to form at least a 1 to 3 month top in that time frame. And that would also be correlated or corresponding to a low in longer term interest rates. And so you saw bonds rally. They kind of accelerated up into early August, consolidated for a few weeks, then spiked to a slight new high in mid-September. But that was all the completion of what I thought was an initial advance in bonds and pullback in interest rates. Pretty much an A wave of what I think would be an upward ABC movement that is correcting the downtrend we saw in bonds from 2020 into 2023. So from that point in the mid-September spike high, I thought we would see a pretty good sell-off in bonds, which has interest rates starting to climb back. And that's what you've seen right now. I do think that it's getting to the point and the time frame. I've said all along that I thought a secondary low would be in October. Among many other things, that's a 1 year, 12-month cycle from the October 2023 low, but there's a lot of other factors more precise and more significant to me that we're saying the same thing. So I do think that bonds are nearing a low. So your longer-term interest rates are probably setting a secondary peak. And from here, I think that you will start to see bonds creep back up towards their August, September highs, and then leading into first quarter of next year, probably exceed those August, September highs. So that would, again, equate to interest rates starting to creep back down and dipping a bit lower in first quarter of next year as the C wave of that ABC upward movement that I described. They have been having, I think, a pretty marked impact on other markets. We've seen the dollar index rally pretty strongly during this downtrend in the bonds as interest rates have climbed again. You have seen stocks starting to struggle a bit, and if if bonds don't start to rally soon, this whole decline could start to weigh more heavily on stocks. So that is certainly something to watch, particularly over the next week or two, if stocks really are coming off of a cycle high, and if they've got some factors like interest rates creeping up again that are starting to worry stock investors. There's always that chance that you could see one of those things where stocks have a quick, sharp correction, and that's what helps set the low in bonds because you get some safe haven buying coming in there. But there's other factors, too, that I think could time a low in bonds and a secondary peak in interest rates between now and the end of October.
Can you explain the indicators that had you forecasting a September low in oil markets and commodity inflation indexes?
That was a combination of your cycle progressions, but also some wave structure and wave support levels that crude oil and as a commodity inflation index, I watch the Goldman Sachs Commodity Index, GSCI, that had cycles bottoming both the index and crude, and that index is more heavily weighted in energy markets, so it's natural for them to be topping and bottoming at similar time frames unless some other commodities have really had a big move to create some divergence in there. But there were a number of cycles coming into play in September. But like I said, it was also a lot of technical and price support that was really the focus of my work. And both crude and the GSCI index were needing to spike below their multi-month lows. In the case of the Goldman Sachs index, I wanted to see it drop below its December 2023 low. And so really when it did spike down in September, it did spike below that low of late last year. It was setting its lowest level in almost years. But that to me was also the best time for at least a multi-week bottom, probably a multi-month bottom, and if certain things are triggered and confirmed in the coming weeks, then it could be even more significant than that. But in a market like crude, it set its low there. It had a nice strong rally on Middle East tension and has since corrected pretty sharply. Right now it's trying to bounce, but for me, crude would not show any new signs of life until you got a daily and then weekly close above 72.50, and I'm looking at the December crude futures. Until it does that, it's kind of back in its downtrend and could even retest those lows. But those September lows, from a timing standpoint, from a cycle and cycle progression standpoint, are very significant to me. So I'm watching them very closely in respect to what the market's doing now and what it will be doing in the coming weeks. That's going to be a key gauge for me for crude and commodity inflation underlying strength or weakness.
What impact do you think the current BRICS summit will have on U.S. markets?
Yeah, that has had certainly a lot of speculation leading into it. We're really in the final day of it now and haven't seen a whole lot of information or announcements from it. There was certainly a lot of speculation that you would see the BRICS nations start to more heavily and overtly push for alternate currencies. And there's talk about the unit, the gold-backed crypto. And while all those things I think are probably very real objectives of the BRICS nations, and really their primary objective is an alternative to the U.S. dollar as global currency leader and foreign exchange leader, it's probably going to take much more time than anyone ever expects to really be able to orchestrate something like that. So depending on what, if there are any announcements that come out today at the culmination of that meeting, it might move the markets a little bit. But I think as you see those nations take additional steps moving forward, that's when you get the impact on the markets. One market in particular was very intriguing to me because I always describe to my readers how the reason that I have become so convinced of the value of technical analysis over the decades is that technicals will often give you the timing and the price for important turning points, whereas fundamentals are often more vague and they lag. And so what I've described, and I'll often point it out when it's happening, is that technicals will often time a turning point and start a new trend, and then about a third of the way into that trend, and obviously you don't know it's a third of the way until the trend is over, and you can look back and say, okay, that was about the 33% fraction or proportion of that trend. But about that 1/3 point is when you will start to see corroborating fundamentals start to kick in. And so when going back to this BRICS discussion, and one of the things that I have been talking about in my weekly relay and Inside Track newsletter is why I thought platinum and palladium were poised to set very significant lows back in third quarter of this year, and why I thought you would see strong rallies into January and ultimately could stretch into May or June of next year in those metals, regardless of what gold and silver are doing. There are some times when it's a precious metals trend up or down, and so the rising tide lifts every boat in the metals when they're going up. And there's other times when it's more independently focused. And so, gold and silver have been steadily rallying for quite some time. Platinum and palladium had been kind of struggling. They did set those bottoms that I talked about and started to give confirming buy signals. I described in a newsletter a month ago why palladium had gone through a textbook reversal sequence, reversal to the upside, based on this weekly, what I call my 21 MAC indicator. And a market has to go through a whole series of moves and average breaks and reversal of averages to fulfill this sequence. And so palladium, after bottoming in early August, went through that whole sequence into mid-September, retraced into late September, early October. At the same time, platinum was going through some similar moves. All that to say is, what do you have but as these markets are confirming multi-month bottoms and starting to gain a little momentum for their uptrend, last week, first China announces or reinforces, they have already been discussing it, but they now put a very specific time frame on it, that they're going to start trading platinum and palladium futures through an exchange in China starting in January. And then 2 or 3 days later after that announcement, Russia came out and said that they would be starting to trade platinum and palladium futures this week. And so the significance of that is that it opens up a whole additional audience, particularly in China. A lot of China individual gold buying has been attributed, or this move up in gold has been attributed to a lot of that type of buying. Well, now you've got Chinese investors and traders having much easier access to buying palladium and platinum. So you have that fundamental kick in after the technicals have already told you to be on the long side, after they've already identified where this market should go and how long an uptrend should take, then the fundamentals kick in as a very strong confirming indicator. And so, certainly no coincidence that China and Russia made these announcements a couple days apart, get more impact, more oomph from that synergy of announcements. And it's all just another facet in the BRICS nations led by Russia and China, offering alternatives to the West, to the U.S., and the economic and financial supremacy that has been held by the West for so long. And like I said, it's just one more duck in a row, particularly for China, where as a competitor, they are certainly laying out and unfolding in a very meticulous, very consistent pattern of setting up these institutions that are going to ultimately offer a more comprehensive alternative to what you can only get from the West. And so all that to say that the BRICS nations are certainly going to continue to have an impact. Whether this summit does have anything that surprises the markets, we'll probably know that in the next 24 hours.
Are there any key cycle progressions aligning in Bitcoin?
Bitcoin, even though it's got only a few years of history and limited data to analyze, and your crux or your foundation of technical and cyclical analysis is a measure of mass psychology. So you need both the masses of involvement and a higher concentration of data to be able to start to really discern some of those key time intervals and price indicators. But even with that said, Bitcoin has shown some very consistent action on multi-month and multi-week basis. And one of those cycles that I had been talking about in recent months was coming into play in November. And it's actually the midpoint, an 8-month interval of a consistent 16-month cycle that Bitcoin has been following. That 16-month cycle is one of the things that I described in reports late last year and early this year, why I thought March of 2024 would time a 3 to 6 month peak in Bitcoin. But then from there, the subsequent peak was and is expected in November, 8 months from that peak, the midpoint of the 16-month cycle. But there's also, it has its own 8-month cycle that has been timing turning points on that cycle progression evolution that I described earlier. And so a lot of my work has been showing that Bitcoin should rally back to its highs leading into a specific time frame in November. There's weekly and even daily cycles that have started to really hone that. And in early October, I published a corresponding report for my weekly relay subscribers that detailed why Bitcoin, it had just pulled back to about 60,000. That was support. It was holding its uptrend at that point. It had a consistent 1 month cycle that was showing a low at that time. And that was when it was starting to generate new bullish signals. And those signals were telling me to look for a rally back to at least 70,000 and probably up to about 73, 74,000 leading into the first half of November. So there are definitely some very consistent cycles that have been unfolding in Bitcoin. And even the technical indicators that I use have been pretty consistent as well. We just saw Bitcoin spike up to about 69,000, then pull back, and it just spiked down to just above 65,000, where I have rising support coming into play. So it wouldn't surprise me to see another rally during this final 7 or so days of October and into that early November timeframe. So I'm watching that first 2 weeks of November, and it's even starting to hone that down to a specific 2 to 3 day period when I think that a top could be put in Bitcoin. And depending on whether this 65,000 level holds as support, that will even hone the upside price targets that I would expect it to get to in the coming weeks.
Eric, where can our listeners subscribe to Inside Track?
They can go to our primary website at InsideTrackTrading.com. And as we talked about in the beginning of this segment, that's inside with an extra I in it. So it's INSIIDE, tracktrading.com. And you can find all the information there for subscribing. You can find a lot of archives of publications to kind of get an idea of how they are compiled. Also a lot of educational and tutorial information on several of the key indicators, including the cycle progression that we've been discussing here today.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. Coming up, Mark Leibovit, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Mark, welcome back to This Week in Money.
Glad to be back, Jim. Thanks for having me.
Do we have a special offer for our listeners?
For new subscribers to VR Trader, we offer a 50% discount using the promo code 2022 half off. Go to VRTrader.com and enter 2022 half off in the promo code section when you place a newsletter subscription. Also, I always like to remind our listeners and also the VR Trader clients that I'm not a financial advisor, nor do I provide financial advice. As a disclaimer, I'm a newsletter publisher.
In Canada, the Bank of Canada cut its trend-setting central rate for a fourth time, I believe, 0.5% this time. The governor of the bank, Tiff Macklem, who sounds like a hockey player from the 1930s, Tiff says with inflation under control at around 2%, he now wants to pick up demand and create job growth. Now, of course, everybody looks at the U.S. Fed. What are they going to do? Are they going to cut rates? Do you need to cut rates?
Well, this is a whole discussion regarding what the central banks do publicly and what they do privately and what's really happening with regard to the money supply and the theory of what the effect of interest rates cuts have on the markets. The most important thing that I look at is what the M2 money supply is doing. And even though the Fed here in the U.S., and I don't know what the equivalent is in Canada, but even though they cut the rates 0.5%, since September, the M2 money supply has grown, and is in effect money creation occurring. So the Fed, what they're trying to do is, I guess, jumpstart a potential risk of recession, or they're trying to goose the markets ahead of an election, but it really questions the alleged independent Fed. So if they're pumping more money into the system, according to the numbers I'm reading, it increased over the past 7 or 8 weeks more than $100 billion. So that's money creation. And what does that do? That filters into the system, creates speculation, more money available for stocks and for investment. And the interest rate cut is irrelevant to really what's happening in the financial sector. Big talk about, a half point does this, and if they lowered another quarter, half a point. Well, what does that really do? Well, again, they're trying to jumpstart any potential problems, but the fact they're increasing the money supply means they're trying to stimulate the economy, and that is more effective than any interest rate cut. In fact, mortgage rates actually went up here in the U.S. in the past few weeks, despite that cut in the interest rate, half-point interest rate. And if you watch the Treasury bond market, it's actually been in a decline, which means higher rates since that half-point cut. So the bond market, it's the old tail wagging the dog, is telling you that rates are going up. So I don't know what the Fed is doing or what it's not doing. It's sort of irrelevant because the bond market tells you rates are going up. So I guess the Fed had no choice but to increase the money supply. So whether they cut it or not, it's irrelevant. Again, we've got to watch what the money supply is doing. We've got to watch what the bond market is doing. And, like I just said, mortgage rates went up. So it's a conundrum here for those who are trying to understand what the really future is. Again, I think the rally in the market is terminal. We're talking about the stock market. I mean, it's running here. It's going to run into the election, maybe run right after the election, depends who gets in. We've talked about this several times. Trump victory would probably make it surge, but it doesn't mean it's going to stay up. It could still run into a correction after the initial surge. And if Harris gets in, who knows? I think it should go down even more so, but, maybe they'll rally at first before it comes down. The market's way overdone. So I think what the Fed's trying to do is the writing on the wall. This recession, the inflation numbers have not come down. If you read John Williams' work, who does a lot of work on shadow stats, for example, basically he's saying that we're probably at a much higher interest rate, inflation rate, that is, than we're being told. And according to him, the CPI methodology that he's put in place, he might even talk about, a 10% inflation rate is the true reality out there, even though we're getting government statistics that say it's come down to 2 or 3%. And, the Bureau of Lying Statistics, which the BLS, you can't believe any of the fraudulent numbers, the CPI numbers, and all those statistics that come out. They're all politically motivated and they're incorrect. So, I think there's sort of a negative scenario ahead, but it's all being goosed up for the election, and we'll just have to look at the numbers, how they come out, afterwards and into early next year. But, I think the Fed realizes there's problems ahead. That's why they're increasing the money supply. That's why they lowered the interest rate. They're always 2 steps behind what they really need to be doing. And I just think there's, a lot more than what we're hearing or seeing in the public financial media. So there's other things we can talk about, but you asked particularly about the money supply situation. How incorrectly had the Fed been in keeping rates low for almost a decade, and how incorrect were they to suddenly jumpstart rates the way they did, which put a lot of financial institutions into jeopardy, particularly the small banks and others that had bought bonds at 0% and now are on the books that are showing significant losses. It would be nice to have done it very gradually or talk the market that this was coming more carefully, but no, it was a dramatic move and caused a lot of problems in the financial sector. Warren Buffett, for example, has been selling a lot of his bank stocks. If you read the reports coming from him, and I think he's one of the biggest, smartest gurus out there. So if he's unloading bank stocks, he sees some problems ahead. And, I guess you enjoy the rally while it lasts. You have fun. The markets go up and down. We try to do the same in our business. But I think there's some warning signs out there, Jim.
A sector that's received a lot of attention is insurance. A lot of people think that the insurance firms have been hit by all of these natural disasters this year, but you have a different take on it.
Yeah, so it sort of turns out is that the thought was that insurance firms would be hurt by all the natural catastrophes out there. And actually, there's a benefit. The property losses are paid out of the reserves of the companies that they have. And however, these catastrophes enable the firms substantially increase premiums. So they really didn't get hurt. And I've been looking at a lot of the stocks like Progressive and Chubb, for example, ticker symbol CB. In fact, Warren Buffett was buying big positions into that company. And the stocks are actually held up or gone higher since the natural disasters. So the property losses, again, come out of the reserves, and it doesn't hurt the insurance companies. History really says insurance companies are some of the best investments out there, and buying insurance is probably one of the safest things you can do because the state regulators, at least here in the U.S., dollar for dollar has to be covered by the insurance companies, and over time there really has been very few financial losses in that sector. So people who buy annuities or life insurance really are not at any great risk because, again, it's almost dollar protection these insurance companies or reserves they have to put aside for any of these policies that they write. So it's really funny. You would think that they would really have been hurt, and but over the last 100 years or so, these companies have prospered and have done well regardless of financial or natural catastrophes. So it's really interesting if you study the insurance sector, what it's really all about.
Well, and also in areas where they do get a lot of claims, California's wildfires, for example, they just don't provide insurance anymore. When there are areas,
smart, right? Yeah. They jack up. Go ahead. Sure, they jack up the rates, or they don't allow you to buy insurance. Right.
Now, how's the gold market doing? We keep hitting record highs week after week.
Well, the BRICS meeting is over. Nothing major came out of the meeting. We didn't see the magical new currency come out that we were all thinking might happen, which would be backed by gold at some incredible number like 10,000 an ounce or something, which make all the gold bulls really happy. My charts say gold's a little overextended here. It needs to pull back a little bit after having this big run. So you might see some indigestion in the gold market here now that no dramatic news came out of the BRICS meeting and so forth. But overall, I'm not a bear on gold, I think, because of the financial instability of central banks, particularly the U.S. here with the incredible debt that we have. You still want to keep a core gold position out there, but if you're trading, I wouldn't be surprised to see a little bit of a pullback there. So, overall bullish, but nervous short term is the best way to describe the technical action on gold here.
Yeah, it looks like the BRICS meeting in Russia was more of an effort by Vladimir Putin to prove to the world that he still has friends than to do anything economic. The proposal for the BRIC unit, as it would be called, would be to be based 40% on gold and 60% on fiat currency. And besides Brazil, Russia, India, China, and South Africa being in there, they want to include countries like Ethiopia. Well, Ethiopia has never been an economic power as far as I know, and why would you want their currency involved?
And, we also have to think about things like, China selling its treasury bonds to buy gold, and which obviously is a problem for our Federal Reserve and Treasury if China continues to dump the Treasury bonds, which I think they're the largest holder of the Treasury bonds. So you have still big buyers for gold out there, and Russia, of course, being one of them as well. So I think, the future is okay for gold, and I still think the BRICS will eventually pull it off, the weight of their number of countries and the gold holdings that they have. I think they control, if I read, about 20% of the world's gold right now. So, the bulls are in their court, no question about it. And we'll see how economic policy and financial prudence changes, assuming Donald Trump becomes elected. If not, then I think, unfortunately, we may be on a more, desperate type course here in terms of whether we're going to end up having treasury bonds default and that kind of stuff happen at some point in the future. Hopefully that's not the case, but I think that's what BRICS is all about, knowing that the path that we're on is one that the end is not very positive, and you got to prepare for an alternate scenario where your currency suddenly is not worth very much. The other side of that is that many people thinking the dollar is going to go to zero so fast, which I don't think it will. I think if you understand some of the mechanisms, and I think you've heard this from other analysts as well, but the purchase of gold by China and Putin and other central banks actually drives the U.S. dollar higher for a while, since you have to transact the transactions in U.S. dollars. But so I think a strong dollar and strong gold overall are with us for a while, but we'll see how the BRICS situation pulls out. The yen carry trade really shook everybody up for a while, but apparently the decision was made in Washington to goose the markets and fudge economic statistics for a while. So we haven't looked back on the yen carry trade issue, but I don't think that's gone away yet. I think that could still raise its ugly head again in the future and might cause some market uncertainty. So we got to keep an eye on what's going on with the yen and Japan. That story hasn't ended, even though it appears it did on the surface.
Now, the yen carry trade, was that borrowing money in Japan at zero or negative interest rates and then reinvesting it elsewhere where you get a greater return?
This was going on for years. Yeah, the yen carry trade. I mean, you have to be sort of sophisticated in your financial wherewithal to pull this off. But yeah, borrowing money at even at current rates, the yen interest rate is still close to zero. It's above a little bit, but it still exists out there. So those are smart enough able to do that. We're able to finance all kinds of purchases, not just stocks, using borrowing in cheap yen and buying elsewhere using that cheap money source. So it still exists. It's still a risk for the markets. And what happened was when we had the big sell-off a few weeks ago, it was because those who were in those yen carry trade positions panicked a little bit, thinking that suddenly rates were going to go up dramatically there and they would have to unwind all their positions overnight. So it quieted down a little bit, and I think, we had a little support here from Washington as well to quiet the markets down and maybe inject some liquidity into the markets, the stock market. Of course, we don't talk about it too much, in the public sector and television, but we do have the plunge protection team out there and the equity stabilization fund that pull a lot of shenanigans in the financial markets that really the financial press doesn't want to talk about. So a lot of stuff's done there, including lack of discussion of the M2 money supply, which I mentioned a few moments ago, that really have more importance and more impact on the markets than people really think. They're always focusing on earnings reports of companies. Whereas you mentioned, what's happening with a half-point interest rate cut and what's the next one going to be like. These are really minor stories if you really look at what's going on behind the scenes. So, for now, that yen carry trade is still a risk for the market.
What's happening in the crude market?
We bounced a little bit, Jim. We've been in a little downtrend, and we started a little rally, and I'm still optimistic, regarding crude oil overall. If Donald Trump gets in, which is my prerogative based on economic policies and so forth, one could argue that could be a damper for the oil market if production is suddenly allowed to increase and open up here in the northern hemisphere, which, as you know, has been curtailed quite a bit by the Biden administration. And you would argue that that might put a damper on oil prices if production is suddenly increased. I'm not really clear how much that would impact it. You would think it would have some impact on oil, and maybe the pullback in oil is in fear of greater production coming on board. So we'll really have to see how this all plays out, because there's still a lot of fundamental reason why crude oil is going to be needed and in demand around the world, and it's not going to zero so fast. So I remain overall bullish for other reasons, mainly because we still need quite a bit of it. It's not all used in gasoline. It's used in all type of industrial processes and electronics and computers and EVs and everything else. So we still very much need it. So the best way to explain maybe the pressure on the crude oil was anticipation of more production coming online.
Anything happening with uranium?
It's been upticking. The world suddenly realized something that we've been talking about for years, that we need nuclear power to really save the world, and it's not going to happen with solar panels or wind power. For years we knew that it was just a function of time until nuclear reactors and nuclear power had to be increased, the production increased to really save humanity. And then I guess what really clicked in, it wasn't the EV market. We talked about this for the last couple of years. People decide EVs are too expensive and you can't charge them, and you don't know what kind of long distance you're really going to need if you can't charge it again. So people start buying hybrid cars like I did because you want to still depend on an alternate energy source. But suddenly AI came along, and AI demands for energy are so substantial that big companies decided to fund some of the public utilities or even private utilities to start producing nuclear power because they needed it to run their new AI operations and generators and computers and so forth. So AI, not the EV, became the trigger for a sudden demand for nuclear energy. And whatever caused it, at least we're getting it underway now. We've got to have 3 Mile Island coming back online, and we have that new Georgia plant, and hopefully a lot of other companies are going to start reinvigorating or starting to get into production some either small nuclear operations or the larger nuclear operations again. So as a result, uranium is doing well. It had a correction, and now it's starting to uptick a bit. And all these companies that are related to the generation of nuclear power, the big one is Constellation Energy, CEG, approaching $300 a share, and I think they're involved with that 3 Mile Island plant, if I'm not mistaken. But more and more demand for uranium and demand on now the part of Wall Street, which is what is behind AI. Suddenly nuclear became fashionable again, and that's what's happening. So, like anything else, of course, we also have lithium, too. There's been a big demand for lithium now because lithium went into a slide when EV sales were down. People weren't buying the cars, and why do we need it? Lithium. So some of the lithium stocks started to uptick. For example, I think it was General Motors made a deal with a lithium company. It's one of the stocks on our list. I'm not going to mention the names. And stock took off a little bit because they wanted to ensure their lithium sources in the future. So lithium came back into fashion along with uranium because now if you got the power out there to actually power up and charge these vehicles, we didn't have enough nuclear power out there or power to begin with to keep enough charging stations operating. So the future is a little brighter now for the EV market and therefore the lithium market too. So everything sort of ties together here. I guess being in the resource area, it's really the place to be. I mean, of course, you've already mentioned gold, and a lot of the resource stocks are doing well. Only crude oil had this little correction, but it's still the future. So lithium, uranium is still there and should be growing.
I haven't heard any mention during the U.S. presidential campaign of a federal legalization of cannabis. Any hint of that as far as you're concerned?
Well, I'm tracking those daily, and, we're trading a few of those, and they're upticking here a little bit. You have to go to our cannabis newsletter or our main newsletter to get the names, but, all the talk about getting it, I guess, fast-tracked in terms of getting cannabis rescheduled, from Schedule 1 down to a Schedule 3, and fast-track that Banking Act, which has been holding up the industry for a number of years, where, companies can't freely do transactions. A lot of banks won't open accounts for cannabis companies and on because it's, officially it's an illegal substance. So you don't want to be involved with an illegal substance, even though individual states have approved it. You don't have that problem in Canada, but here in the U.S., it has been a problem. So a lot of hot air is being thrown around about how this is suddenly going to change, and it goosed up some of the cannabis stocks here in the U.S., which, by the way, are the only really profitable companies. Most of the Canadian companies haven't done well at all, but a lot of the domestic U.S. companies, and again, those names are in our newsletter, actually had turned profits, have been profitable, have been expanding. Some have been buying back their own stock. So those are the ones that have attracted some interest. And one or two of those names are sort of holding their breath on the November election, one in Florida, where if that's certain, marijuana, cannabis legislation passes, that would help the expansion of some of these companies in Florida, which is a big market for a lot of these U.S.-based cannabis companies. So I don't know how bright the future is. There's been a lot of hot air and talk about all these federal laws changing here in the U.S. from the rescheduling of cannabis and also that Banking Act, but nothing really has happened except a bunch of promises and expectations. So whether Harris, which I hope is not the case, gets in, or whether Trump gets in, we'll see what the outcome is for the industry. The trend seems to be to loosen up all these regulations and get the deck cleared off, once and for all. I mean, drinking alcohol and the prohibition was supposedly a big change for America. It's the same nonsense with cannabis. I mean, you're not going to stop it. That people are going to drink liquor, and they realize a prohibition didn't work. So the same thing with cannabis. If you're going to prohibit and schedule it into a level which makes it illegal, I mean, it's just nonsense. People are going to do it anyway. So you might as well just clear the slates and let people do what they want. If they want to get drunk, if they want to get high, that's their business. Doesn't mean everybody. Of course, you have restrictions like 21 years of age or something to try to keep kids away from it. But, the reality is stop holding up political obstacles to something that's happening anyway. So I think overall it should be bullish going forward over time. They just have to clear these hurdles.
Yeah, you said in Canada the cannabis companies are losing money, and everybody laughs, saying only the government could lose money selling drugs.
Right. Well, the Canadian companies overproduced. They got ahead of themselves, and some of these stocks did really well. I mean, Canopy Growth, which went public was in 2014 or 2015 at $1 a share, and it went up to $58 a share. So there were a lot of expectations for that company, but it was mismanaged, and others as well. But a lot of it had to do with speculation, overproduction, and so forth, and the hope that the U.S. market was going to open up a lot sooner than it did. So, it's a business. There are people making plenty of money. A couple of these companies, for example, in Florida that we have in our newsletter, are, really making money, expanding new operations. They're selling cannabis. I mean, things are booming for them, and for good reason. A lot of the senior folks, I know here in Arizona, find a lot of benefits in CBD and in cannabis for health reasons. And more power to them, So if it's a senior-only market, that's fine too, as long as you find a benefit for using the stuff. I don't take it myself, but I know my wife took some CBD for a while, and she said it had some benefits. So give it a shot.
On the cryptocurrency front, what's going on?
A little uptick there. Along Bitcoin, it's just sort of hanging in this high 60,000 area, and I'm just waiting for it to break out above that 73,000 level, in which case it's probably going to be 85, 90, 95 pretty fast. So you got to be patient, because this market runs in apparently a couple year cycles. It runs really hot for a while and then cools off for a year or so and then takes off again. So, and also, we have the BRICS situation, the BRICS nations. They're talking about getting involved with the crypto world, and you have to remain positive, because the big players, like Larry Fink at BlackRock, who proposed the ETF for Bitcoin, last year, and he manages the biggest fund in the world, the BlackRock Fund, and trillions of dollars under management. And they got the Securities and Exchange Commission to clear it and to start the trade. So this is like, GLD, the gold ETF. Once that got cleared, it provided buying support for the underlying product. When you enter an order in the ETF, your ETF has to go out and execute the physical commodity to support the purchase. So that goosed up the Bitcoin market and remains as a floor there for future buying it, plus allocations on the part of institutions. Now there's an ETF for it, and of course we're only talking about Bitcoin here. But there's also talk that the Ethereum ETF is going to be coming out pretty soon too. Big institutions have asset allocations in all kinds of markets, and certain allocation is going to become sort of mandatory in the crypto sphere, Bitcoin or Ethereum in particular. So that's going to provide future support. So it's here to stay with BlackRock behind it. An ETF trading, it's not even a question. I know a lot of people think they're worthless and it's going to go to zero, and it's just a false market. I don't think so. I think it's going to be here to stay. And around the world, in many places of the world, you really can't execute transactions unless you have a crypto access or Bitcoin access. And not everything is done the way we do here in the U.S. with credit cards or checks. Depends where you are in the world. So it's sort of universal accessibility to buying and selling goods with the crypto market. And that's why I think it also has, merit in being there and expanding over time. So governments could threaten to get rid of it. They can do all they want, but it's here to stay, in my opinion. So anyway, I'd be a buyer of Bitcoin, Ethereum on any weakness. If you take a longer-term view, and if you're trading day-to-day, that's a different story. But, we're in it, and I think it's still a big part of our financial future.
Keeping your eye on the sky and your ear to the ground, anything interesting on the geocosmic front?
Well, there's always something coming up there. We have a lunar cycle coming up here in a couple of days, so we got to watch out for that. Another, new moon coming up ahead, and there has been just reported in the last 24 hours or so on spaceweather.com. There's another one of these sunspots that apparently rotates around the sun, and there's a number of them, and when somehow it aligns with the Earth, and this doesn't always happen, sometimes it aligns with other planets, Mars and others, for example, but when it aligns, that opens up the risk of solar flares moving toward our planet. So there's like an alert out now that one's heading, starting to face toward the Earth soon, and we'll have to see if that has the impact, or any impact at all. But it's something being monitored, like watching the weather or Earth cycles and other stuff, which we do. But that's always a risk. But you could sit here worrying about that forever and it never happens. But there is something being reported now, so we got to keep an eye out for that. And of course, the impact is not just worrying about it. If it does happen, it affects our satellites, including the space links that Elon Musk has up there, and Starlinks. Not space links, and others. Satellites and space station and other things circling the planet. These emissions do distort, communications and can blow up equipment and all kinds of things. So it's important that we do monitor it. And if it's big enough, it'll affect us in a big way here on the Earth, like you saw with that Carrington event back in the 19th century. But yeah, so we're just watching them, and it's like watching, hurricanes move around the planet and typhoons move around the planet. I guess if you're not in the path of one of them, you don't pay much attention to. But if you've been in Florida this past year, you've got a couple direct hits that, of course, you paid a lot of attention to. So we'll see if this turns out to be anything. But, there's stuff out there, and we're watching it.
Mark, before we go, perhaps tell our listeners a little bit about VR Trader.
VR Trader is thank you for bringing it up. It's my newsletter. It used to be called the Volume Reversal Survey when we launched it back in 1979, basically based on my technical indicator, the VR, the volume reversal. And what we have done using that is determine, which indexes or which stocks are showing, more buying or selling by volume changing in those markets or those stocks. And we ended up changing the name to VR Trader. So most of what we have on our list is based on, positive volume changes to the upside or to the downside, and putting those recommendations on our list, which is published every day. And the biggest letter is the VR Platinum letter that covers just about all the markets. But that's, we also incorporate some timing cycles and so forth, seasonality issues. A funny thing called Turnaround Tuesday we use every week. We find on many occasions markets change direction intraday or for the day on Tuesdays, and little things like that. There are short-term cycles that we try to play off or warn our clients about, including option expiration days and things like that. But for the most part, we're looking at those volume changes at vrtrader.com.
Mark, thank you so much for being on This Week in Money.
It's always fun. Thank you so much, Jim. Thanks for having me.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was speaking to us from Arizona. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Mark Leibovit. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.